Most people never lose money in the stock market. They lose it in the gap between what they thought investing was and what it actually is. That gap has a cost. It is measured in dollars and in years. This is what it looks at every stage. Level 1, $0 to $100. You have downloaded the app. Maybe it was a Tuesday. Maybe you saw something online. Maybe someone at work mentioned a stock by name. And the name stuck. And 3 days later, you are staring at a green and white interface asking you to connect a bank account. The deposit is small. $20, $50, the round number you picked, because it felt like an amount you could afford to lose. You are not wrong about that. You can afford to lose it. What you cannot yet afford is to know what losing it will teach you. At this level, the market does not know you exist. That is not a metaphor. The algorithm behind the platform you are using has categorized your account in a tier that generates no meaningful revenue for anyone. Your $20 is not being managed. It is being held. The brokerage earns nothing material from your position in a fractional share of a company you have heard of. You are here because the app needed user growth numbers, and you are one of them. The welcome screen was designed to make you feel like you belong. You do not yet belong. You are at the edge of the room. What you own, if you bought anything, is a fraction. Maybe 0.18 shares of something trading at $280. The number in your portfolio section goes up 0. $40, and you feel something that is difficult to describe accurately, but feels like a preview of a feeling you want to have more of. It goes down $0.62 the next morning and you check the app 4 times before noon. You are not investing yet. You are learning what it feels like to have skin in a game whose rules you have not fully read. That education has started. It is going to cost more than $20 before it is finished. The platform gives you everything a level 8 investor has access to in terms of interface. The charts look the same. The newsfeed looks the same. The order types are the same. This is either democratizing or disorienting, depending on how prepared you are for what the tools actually do. At this stage, you are not prepared. You are excited, which is a different thing entirely. The system is indifferent to your $20, but the system is patient. It will still be here when you have more. Level 2, $100 to $1,000. Something shifted. You added money. Not because someone told you to, but because the idea stayed with you longer than most ideas do and you found a way to fund it. You have somewhere between $100 and $1,000 in a brokerage account, and you have made at least 2 or 3 actual decisions, meaning you looked at something, thought about it, and pressed buy. The positions are small. The returns, positive or negative, amount to coffee money. But you are now a person who has positions, and that is a different psychological identity than someone who only has savings. This is where the first real loss happens for most people. Not a catastrophic loss, a $47 loss, a $93 loss. Something small enough that it shouldn't matter, and large enough that it does. You bought something because it had gone up for several days in a row, and you believed, not consciously but functionally, that it would continue. It did not continue. It dropped 9% in a single session, and you watched it happen in real time and did not sell because selling would make the loss real and not selling kept it theoretical, and you needed it to stay theoretical for a little longer. This is not stupidity. This is a completely normal human response to paper loss. It is also exactly the cognitive pattern that turns a $93 loss into a $340 loss if left unexamined. The platform, at this balance, still offers you nothing special. No research tools beyond what anyone can access. No priority support. No advisory relationship. If you have a question about why your order didn't execute, you submit a ticket and wait. If you want to understand what a limit order is versus a market order, you search the help section or you search the internet. The brokerage is not teaching you. It is facilitating transactions and hoping you stay active enough to generate order flow revenue. Your education at this level is self-directed by necessity. You are developing opinions now about specific companies, about sectors, about whether the market is overvalued or due for a correction. These opinions are built on a few months of attention and several articles, and maybe a podcast or two. They feel more solid than they are. The opinions are the most dangerous thing you own at level 2 because they are confident enough to drive decisions and uninformed enough to make the wrong ones. What saves most people at this level is simply not having enough capital to do significant damage. The tuition is affordable. The lesson is not optional. Level 3. $1,000 to $5,000. The number in your account is now large enough that losing a meaningful percentage of it would genuinely bother you. Not devastate you, but bother you. This distinction is important because it is the first time the emotional stakes of the game have real teeth. You are not playing with house money anymore. You are playing with money you transferred from savings you built deliberately, and the weight of that is different. This is where most people pay what eventually gets called the learning tax. It goes by different names. Some people call it tuition. Some people call it their crypto phase. Some people don't name it at all because naming it would require accounting for exactly how much it cost. The learning tax is what you pay to discover, through direct financial experience, the difference between what you believed about markets and what markets actually do. At this level, those beliefs get tested in live conditions for the first time. The sample size of your experience is just large enough to feel like evidence. It is not yet evidence. It is anecdote wearing the clothes of a pattern. A specific thing happens at this level that almost no one escapes. You find a strategy. Maybe it is buying stocks that have dropped 20% in a week on the theory that they will bounce. Maybe it is following a particular account online that seems to call moves correctly. Maybe it is concentrating in a sector you work in and therefore believe you understand better than the market does. The strategy works 2 or 3 times. This is genuinely the worst thing that can happen because it builds conviction in something that has not been tested across enough conditions to be trusted. The strategy then fails, and it fails in a way that costs more than the earlier wins returned, because by the time it fails, you are sizing the positions larger. The account at this level is somewhere between $1,000 and $5,000, and the swings feel enormous, even when they are objectively small. A 15% drawdown on a $3,000 account is $450. That is a real number that takes time to rebuild. The psychology of rebuilding is different from the psychology of building. Building feels like forward motion. Rebuilding feels like standing still with extra steps. You are developing something at this level, though. Not wealth, not yet. You are developing a data set of your own behavior under pressure. That data set is going to matter more than you think at the next level. Level 4, $5,000 to $25,000. Something has happened to get you here. Either the market helped you, or time helped you, or income helped you, or some combination of all three. You have real capital now. Not life-changing capital, but capital that requires actual decisions rather than intuitive ones. The difference is subtle from the outside. From the inside, it is the difference between playing a practice game and playing a real one. Pattern recognition starts here, but it is unreliable, and you don't know yet which patterns you're actually seeing. You have been watching markets long enough to notice things. You notice that certain stocks behave differently in earnings season. You notice that your emotional response to volatility has changed, not because you have mastered your emotions, but because you have seen enough volatility that the first wave of panic no longer convinces you to act immediately. That delay, even a 48 hours delay between the impulse to sell and the actual decision, is worth more than it sounds. Most retail losses happen in the first 48 hours of a drawdown. The fees become visible at this level for the first time in a meaningful way. Expense ratios, fund management fees. The difference between a 0.03% index fund and a 0.75% actively managed fund. These numbers look like rounding errors until you run them out over 20 years on a $20,000 position. The difference between 0.43% and 0.75% on $20,000, compounded annually over 20 years. At 8% market returns is not small. It is close to $18,000 in net difference on a single position. The cost of not knowing this is real, and you are reaching the level where the math of small differences starts to matter. The market, as a system, still has no opinion about you. You are a retail investor. Your trades are absorbed without friction. When you place an order, no one on the other side knows your name or your reasoning. You are one of millions of small accounts making directional bets that the aggregate market barely registers. This is humbling if you think about it too directly. You will stop thinking about it too directly, and that is probably correct. What matters at this level is not being seen by the market. What matters is seeing the market more clearly than you could 3 levels ago. Level 5, $25,000 to $100,000. The compounding click is the moment, and it is a specific moment even if you cannot pinpoint the exact day, when the math stops being theoretical. Your account has made more money this month from market movement than you deposited. The market returned more than your contributions. This has been mathematically true for a while, but at this balance it becomes psychologically undeniable. You feel it differently. The account is doing something without you doing anything, and the something it is doing is large enough to register. This is the level where behavior determines trajectory more than any factor outside your control. Two investors, starting level 5 on the same day with the same amount, will arrive at very different versions of level 6 depending almost entirely on what they do when the market drops 18% over 6 weeks, which it will. One of them will hold. One of them will move to cash to stop the bleeding and miss the recovery. The one who missed the recovery will be underwater relative to the one who held, not because of the drop, but because of the missing of the bounce. Market recoveries do not send announcements. They are only visible in retrospect. Your brokerage has started to notice you. Not with personal attention, not yet, but algorithmically. You are being offered products you were not offered before. Margin capability. Options trading approval levels. The platform is reading your balance and your activity and surfacing products that are appropriate for accounts of your size. Some of these products are genuinely useful tools. Some of them are ways to amplify your losses if used without understanding. The platform does not differentiate clearly between the two in its marketing. That work is yours to do. Tax efficiency becomes a real consideration for the first time at this level. The difference between holding a position for 364 days and holding it for 366 days can be the difference between short-term capital gains taxed as ordinary income and long-term capital gains taxed at 15%. On a $15,000 realized gain, that difference is real money, potentially $2,000 to $3,000, depending on your income bracket. The system has incentives built into it, legal and accessible ones, and at this level, you are starting to have enough capital that using them correctly produces meaningful results. You are learning the actual geometry of the game, not just the surface of it. Level 6, $100,000 to $250,000. This number carries weight in a way that the earlier numbers did not. Not because of the lifestyle it enables, which at $150,000 invested is actually modest in terms of what it produces annually, but because of what it represents structurally. You are in the top roughly 10% of American investors by account size. Most people who start investing never reach this balance, not because they couldn't, but because they stopped somewhere between level 2 and level 4, when the gap between current reality and future possibility felt too abstract to sustain behavior. The conversations around you change, not dramatically and not all at once. But when the subject of money comes up in a room, you are no longer silent. You have context, you have vocabulary, you have made enough decisions with real consequences that your perspective has texture the conversation can use. This is worth noting because it is a form of compounding that has nothing to do with the account balance. The knowledge compounds alongside the capital, and at this level the knowledge is starting to become genuinely useful beyond your own portfolio. The brokerage relationship is meaningfully different here. You are likely eligible for a premium service tier. The fee structure on trades, if there are any, is better. The research tools available to you are more sophisticated, not retail research with ratings and price targets, but actual data feeds, deeper analytical tools, access to third-party research that has historically been sold to institutional clients. You are not being invited into the institutional room yet, but you can see the door from where you are standing. The person managing your account, if you have one, is a real professional with credentials and a compliance record you can look up. The advice they offer, even when it is imperfect, is calibrated to an adult with real capital, rather than a beginner being onboarded. Serious money attracts serious decisions, and serious decisions attract the possibility of serious mistakes. This is the level where the expensive errors happen, not the $93 tuition payments of level 2, but the $30,000 concentration errors, the single stock bet that felt justified by deep research and cost 3 years of progress. The sophistication of your knowledge at this level is sufficient to construct complicated arguments for decisions that are fundamentally just conviction dressed in analysis. The market does not care how sophisticated your reasoning was. The market cares about whether you were right. Level 7, $250,000 to $500,000, the invisible threshold. It is invisible because no one tells you when you cross it. There is no notification, no status change, no email from the platform. You cross it, and the number in the account changes, and the world looks mostly the same. But something structural has shifted that becomes apparent over the following year or two. The asymmetry of your position has changed. A 10% gain on $400,000 is $40,000. That is more than the median American household saves in an entire year. Your market participation is now generating wealth on a scale that most income-based strategies cannot match. The engine of compounding is not a concept at this level. It is a mechanical reality producing output you can measure in specific dollar amounts that relate directly to the life you are building. The abstraction is gone. The math is concrete. Private wealth management becomes genuinely available rather than theoretically available. This distinction matters. At level 5, you could technically access certain advisory services. At level 7, you are large enough that the better advisors actively want your relationship. The fee structures are negotiable. The investment products available to accredited investors, which you are at this balance, include private equity funds, hedge funds with minimums starting at $250,000, real estate syndications, and structured products that do not appear on any retail platform. These products carry their own risks, significant ones, and the access to them is not an automatic improvement over index investing. The access is simply real in a way it was not before. The emotional experience of level 7 is quieter than the earlier levels. Not easier, quieter. The anxiety is less about survival and more about preservation. The psychological shift from accumulation mode to preservation mode does not happen cleanly or quickly, but it begins here. You are starting to think in decades rather than months. The question is no longer whether the account will grow. The question is what you are building it toward, and whether the strategy you are running will hold its coherence over time frames that are long enough to matter. That is a different kind of thinking than what drove you through level 3. It requires a different kind of patience and a more honest accounting of your own time horizon. Level 8, $500,000 to $1 million. The first million is the number that exists in the culture as a marker. You have heard the word millionaire your entire life. It carries cultural weight that has almost nothing to do with the financial reality of what $1 million can and cannot do in the current economy. That gap between the mythology of the number and its actual function is something you will have about 72 hours to sit with before the practical reality of managing it reasserts itself. The mythology fades quickly. The math does not. At just over $1,000 in investable assets, your relationship with the financial system undergoes a categorical change. You are not a better retail investor. You are no longer a retail investor. Private banking relationships become standard. Institutional-grade custody solutions replace the consumer brokerage account you used to get here. The people managing your relationship have conversations with you that are different in kind, not just in tone, from the conversations that happened at level 3. They are asking about estate structures, trust vehicles, generational transfer strategies, tax optimization across accounts and entities. These are not upsells. They are the actual mechanics of managing capital at this size. The market, as a system, begins to treat you differently in small but measurable ways. Your order sizes are large enough that execution matters. The difference between a market order and a carefully timed limit order on a $200,000 block position can be thousands of dollars in slippage. Institutional brokers offer you direct market access and better execution infrastructure because your trade volume justifies the relationship. The tools available to you were designed for this scale. They are not scaled-up versions of retail tools. They are a different category of instrument entirely. The thing that is difficult to communicate about this level is that the work does not disappear. The decisions do not simplify. What changes is the quality of the infrastructure around the decisions. You have access to better analysis, better execution, better tax guidance, better legal structuring. The decisions themselves are still yours. The judgment is still yours. The market is still indifferent to whether you are right. $1 million in the wrong asset, held through a thesis that does not resolve, is still a loss. The system will not protect you from being wrong. It will simply give you better equipment for being right. The account balance does not change who you were at level 1, staring at an app on a Tuesday, making a first deposit that the system ignored completely. The market did not care about you then. It does not care about you now in any personal sense. What has changed is not the market. What has changed is your position within it. That position took years to build, required a specific kind of loss at almost every level, and will require maintenance to keep. The number is real. What you do with the infrastructure it unlocks is still entirely up to you. The journey from $20 to $1 million is not a story about money. It is a story about the development of a relationship with uncertainty. At level 1, you were afraid of it. At level 8, you have simply been in it long enough to know its patterns. That is not the same as controlling it. It was never about controlling it.